So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm with a special guest. He's Darcy Norton. He's a contributor on Seeking Alpha, and today he's going to show us the research that he has done on Acadian Timber. And so, please, Darcy, introduce yourself, tell us a bit about what you do, and then we'll jump into the presentation.
Thanks, Giacomo. So as Giacomo mentioned, I've been an active market participant since 2016. I've also started writing on Seeking Alpha, started in February of 2022. Before this, I ran a couple of small businesses, and I have a master's in finance degree from St. Mary's University in Halifax, Nova Scotia. So Acadian Timber is a small cap logging company based in Edmundston, New Brunswick, with operations in New Brunswick and Maine. They have a market cap of about $300 million, and they produce mostly softwood, hardwood, and biomass. And the softwood and hardwood is produced in lumber and in pulp. They trade on the US OTC market, which is over the counter, and the Canadian TSX. And the TSX is their main listing. And due to this, I'll be talking, all the numbers today will be in Canadian dollars. It's also worth noting that the company is fairly thinly traded. So investors should keep this in mind when they're looking to buy or when to sell. So what originally brought my attention to Acadian Timber was their dividend yield. But upon closer inspection, I noticed that this is a fairly special company in their sector. So they have the longest dividend. They have the longest dividend paying in the sector, starting in March of 2006. They've been increasing the dividend fairly consistently ever since 2012, and they don't do this on any schedule. They have a dividend policy to pay out 95% of their free cash flows. And so right now they're currently overpaying, but I'll get into why that's not much of an issue later in the article. And at the moment, they have a dividend yield of between 5 and 6%. So another really interesting thing about this company is they really have a unique ownership, and they really have unique people running the company. So in 2019, Brookfield Asset Management, which is one of Canada's premier private equity firms, sold their 45% interest to Macer Forest Holdings. And I kind of thought this was a little bit odd because I've never heard of Macer Forest Holdings before. So I decided to look into them a little bit, and I discovered that they're owned by Malcolm Cockwell. And Malcolm Cockwell is a very established person in the forestry industry in Canada. He's the managing director of Halliburton Forest and Wildlife Reservations. He sits on the board of Ontario Forestry, and he has a PhD in forestry. All that being said, it did raise some eyebrows as he is fairly well established and he does have a very good paying job, but I didn't see how he could afford $150 million to buy this company. So when I looked a little further into him, I noticed that his father actually sat on the board of Brookfield Asset Management and is one of Canada's billionaires. His name is Jack Cockwell, and he was actually one of the founding partners of Brookfield Asset Management. So the reason I bring this up is because Macer Forest Holdings is Brookfield adjacent. It is not indirect. It is not a completely independent company. And I actually kind of see this as being favorable, as Brookfield no longer gets the management fees or the royalties from Acadian Timber. And Malcolm seems like he is an excellent operator because Halliburton Forest and Wildlife Reservation has done a tremendous job in recent years. And they're actually considered to be one of the leading forest operators in Canada. And they're following the German approach to forestry, which in my opinion, may help them with carbon credit projects in the future. So if anyone wants to look further into that, you should look into the Scheffelbloms of Halliburton Forest.
Okay. Is it possible to talk a bit more about what it means, the German model of forestry?
Yeah, absolutely. So the German model is they're big proponents of privatization of forests, which is a controversial subject in Canada since we have so much crown land. But basically, the argument goes is that they take better care of the forests. So what Schaffelbaum said in his interview, I believe it was with the Globe and Mail, is he said what they do is they cut all the profitable trees and they cut all the sick trees. So this leaves room for all the younger trees and different types of trees to just exist, and they don't do any clear cutting. So when this happens, you get a healthier ecosystem, you get less fires, wildlife can continue to exist, and you have a diversity of species instead of just a monocrop, which can be fairly devastating for a forest ecosystem. And so in this way, you can have a forest kind of maintaining itself for much longer. And although it might not be profitable right now, you're going to have much healthier ecosystems going forward.
Okay, okay, interesting.
Mm-hmm. So one of the reason I initially thought I should write an article about Acadian Timber is that I saw that they have a really strong dividend yield, and that they were really starting to struggle during the pandemic. And as I think most of us remember, in 2020 and 2021, lumber prices were exploding. So I thought this company should be doing fairly well. But what I didn't realize is that even though Acadian Timber isn't immediately impacted by COVID restrictions, their sales are, because the mills and the downstream users of their products were affected. So they were not able to sell as much, and this impacts their profitability and their ability to make sales. So I thought as the free cash flow, as the pandemic restrictions lift, the free cash flow should normalize. And then upon further looking into the company, I noticed that they're starting a carbon credits project. And so this will increase the asset efficiency of the company. And that will be, there'll be an upfront cost to setting it up. But after that, it's a very consistent yield with very little cost of production. And then we started to see inflation take hold, and it doesn't look like Canada is going to be seeing declining lumber prices anytime soon. We're actually increasing our immigration numbers. I believe it was Thursday we decided to increase them of another 10,000. And so if you look how it was, where immigration was about 10, 15 years ago, we were around 150,000 per year, and now we're up to 411,000 per year. So we should continue to see a housing glut and new home builds occurring. And so with all this, you should see the dividend either remaining flat or even increasing, but you should definitely see it being safe, and you should see additional values to the book value of the company. So something else that also caught my eye was that Acadian Timber has done a great job of managing their debt. They've recently taken on about $100 million, which has severely impacted their credit rating, but they've structured it fairly well. So they have two tranches coming up in 2025 that will need to be either rolled or paid off. And then the rest happens, I believe the next one after that is 2028, and then 2029, they have to pay it all. But they still have significant liquidity. They've locked in their interest rates until 2025. So they may actually miss the rate hike cycle, and they actually may see significant savings as inflation will just eat away at their debt. So this, I thought, was actually a sign of a very well-run company as well. So they do have some headwinds. I see most of these being short-term in nature. So COVID policy, New Brunswick had a lockdown. I believe it was 6 days in January, or it might have been February. I believe it was January. And this will slow down the production of the mills where they sell to. And as you can see, I don't remember the mill off the top of my head, but I believe it takes about 26% of all their production. And so that mill, I believe, had restrictions placed on it. And so it cannot operate at full capacity. And I believe this will impact their sales. Weather has also been pretty extreme. Well, not extreme, but has been pretty erratic in Atlantic Canada as of late. We've been getting a lot of snowfall. And then as you can probably see in the sunlight, we're getting a lot of thawing very soon after. And so what this causes the ground to heave, especially in forests, and this makes cutting of lumber a lot more difficult. So as you're cutting, you don't know if there's a pocket underneath of thawed ground, and this can cause a tree to heave, and you don't know which direction it's going to go. So it becomes a lot more dangerous. And Acadian is very happy to say that they're pretty safety conscious. And so this will slow down their production. And it also slows down the hauling of logs out of the forest, as it could get caught on heaved ground, and it just makes it more difficult. Another thing was the carbon credit setup. So it's expensive to set up these projects. There's significant regulations. So I expect there to be some one-time costs, and they did not mention it specifically in their Q4 report, but I believe that's part of the reason why the earnings per share was lower than expected. And then the final part I wanted to mention was the market momentum. And so I'm not talking so much about the general market coming down. Well, I am, but I'm more so talking about how the Federal Reserve is looking to hike rates, and then they're also stopping quantitative easing. And I'm a pretty strong believer that when the Federal Reserve stops doing quantitative easing, or any central bank for that matter, the asset prices of that region typically fall. And so I'm expecting a general price decline, and I'm also expecting that this may hold back future appreciation. That being said, I think if someone examines shale gas during 2007 to 2009, you'll see it's pretty explosive growth, but it's just something I wanted to keep in mind. So that brings me to the valuation. So I did 3 methods of evaluation to get the thought process of the different market participants. And I also wanted to see which one matched up the best with how the company trades. And so I found out that the book value is the one that most closely reflects how the company trades. And this is pretty well expected because most mature companies trade around their book value or their NAV. And so what I did once I found that is I took the historical prices, which you can see the historical prices for the book value in blue, and then the market prices, that's in the pinkish orange. Okay. And so you can see where it trades at a premium and where it trades at a discount, and just kind of get a good idea. And so you can see it usually trades at a premium, and this is a pretty telltale sign of a well-managed company. And so I think this is a good sign that this is probably a market leader. And so you can also start to see that there is areas where you can capture price declines. And so if you're looking at this, you might not be able to see it, but it usually trades at about a 4% premium, 3.5% to 4%. And that's actually around where I would say this company is a pretty strong buy right now. But it has been at a discount, I believe, in 2020 of up to 23%. And it goes up to about a 20% premium, and it rarely goes above that. As you can see, I just want to point this out. It's about a 10% premium to book value at 17.47. That number is from December 31st. I don't project book values, but just as a general rule of thumb for this company, I'm just kind of saying a plus or 5% on that 17.47 is probably around where the book value is at the current time. So now I figured I should definitely touch on the earnings. I did make earnings predictions for Q4. Unfortunately, I was wrong about this. I projected that the earnings per share would remain around 90 cents. That was not the case. It was a pretty significant earnings miss in my part. This is mostly because of rising costs and market difficulty in the pulp market. And also there was a $6,000 in unrealized gains in addition in 2020 that wasn't there in 2022. So just to reiterate, that was 12 million in 2020 and only 6 million in 2021. It was nice to see that the free cash flow is starting to normalize, rising by 1.7 million. And this is leading to further free cash flow payout ratio normalization. And so I'm still expecting to see that normalize by the second half of 2022. And something that was very bullish for the company is they added a DRIP, so a dividend repurchase plan, and a 5% share buyback. And Macer Forest Holdings said they are going to participate in the DRIP. So we could see quite a lot of the shares starting to get eaten up. And then when you look at the 2021 annual data, you can see that the company is starting to normalize again. Free cash flow growth is around $1, which is it's fairly decent growth in the 91 cents. And it's not quite to where 2019 was, but it's getting close. 2021 is also getting much closer. It's only about $5 million less than 2019, but you're still seeing a nice bit of growth from 2020. And the most bullish thing I've seen is that the EBITDA is starting to recover a little bit. So it's still fairly flat, but I believe as their projects start to come on board, the carbon credits and sales start to normalize and inflation takes hold, we'll see a little bit more appreciation here. So I'm enjoying seeing the EBITDA climb. So just to reiterate my positions, I think the company is really strongly positioned right now due to them getting involved in carbon credits, their well-positioned debt, and inflation increasing the cost of the goods they sell. And all their headwinds are temporary. Setting up carbon credits will probably be a recurring thing, but as they get better at it, it should become less costly. COVID policies are starting to wane. Obviously, we can't tell if there's going to be any further waves. Let's all hope there's not. But if that's the case, then we'll just have to weather. But I imagine, are getting pretty good at weathering these. The weather, it's almost springtime, so we should see that coming to an end. And last year, we actually got to see that both in COVID policy and weather, we had a very similar situation, and they simply pushed up their everything into the next quarter, which was really nice to see. And it was actually the first time they've done that in about 5 years. So it's nice to see they got that flexibility. And then you also have market momentum, but I think the inflation and the demand for softwood and hardwood will pretty much offset that, but it might see a little bit of dampening in the price. And on top of all this, even if the company basically trades at $19 next year, which is around where it is right now, I believe $19.50, you're still getting around a 5.5-6% dividend yield, which you can just put in your pocket. So I think this company is pretty strongly positioned moving forward, and they've done a very well job executing.
Okay. So you explained all your concepts in a very clear way. I have a few questions. Even though it's a small company, do you think are they going to grow also thanks to the ESG market that is growing? And since you said that they are having this policy of German foresting, or will they get? Do you think will they get cheaper capital in the future?
I think because they're so small, it might be a little bit more difficult, especially compared to some of their competitors. So, but I do believe it's an option. And the more they move into the carbon credits, I think they probably will see that more. But I don't think logging is too ESG friendly company. In fact, when I read the credit reports on the company, they hardly even mentioned ESG. So I thought that was a little bit strange. But I'm hoping that they will, but I'm not making any predictions on it.
Okay. Can you explain a bit more in depth the concept of carbon credits? So from what I know, a lot of companies try to offset their emissions with planting trees and so on. But can you go more in depth in this process of carbon credits and how that works?
Yeah, sure. So carbon credits are basically carbon negative projects, and there's different types, and there's different regulatory areas. So there's RED, there's VERS, and those are the two that comes to the top of my mind. Oh, there's gold standard. And so different areas of the world have different jurisdictions for them. And so basically the concept is that, say you have a forest, you have to maintain that forest, you have to make sure that forest is continuing to be carbon negative. Then you can sell carbon credits to offset, say, BP or Shell actually just last year had a massive fine from Dutch, so they had to pay it all in carbon credits. So by doing that, so the idea is that you're going to be carbon neutral, not through your projects, but by maintaining other projects that are carbon negative around the world.
Okay. Okay, okay, interesting. And one last thing that I'd like to ask you is how this company is positioned for the current geopolitical situation. Is, for example, timber following the same path that other commodities are having by rising up in prices? And is um, is the sanctions are the sanctions on Russia making timber more expensive and therefore making these companies revenue earning um, and earnings grow more likely to grow, let's say.
So in a roundabout way, I'd say yes, because I think it will continue to drive up inflation. But because Acadian Timber almost exclusively sells to local mills and producers, I would say it's not going to have a large effect. Maybe if we get a large influx of refugees, like we did with the Syrian conflict, that might happen. But I'd say mostly Acadian Timber, their growth and their demand for their product is going to be mostly due to immigration and housing demand. A lot of the timber markets around the world are pretty localized. It's not very often that we'll be buying wood from Europe to build our houses here, but so I'd say it's not going to have an outsized effect. Commodities such as iron or especially wheat and fertilizer are probably areas you want to look a little more there.
Okay, okay, okay. That's interesting to understand what are the implications of the current situations in this market. So thank you again. I'm done with the questions. If you want to add anything else, free to do so. And I really want to thank you for being with us and sharing your insights with us today. So thank you, Darcy. Yeah.
Thanks, Giacomo. And actually, there's just one more point that I forgot to add. Um, there's a lot of people talking about the valuation metric of selling the Acadian timber based on their real estate value. And I don't really see that as being a feasible option just because there's not a lot of endowment funds that will want to buy Acadian timber and not get the cash flow from it and just get the timber value. And also, if they do, they will probably be selling to one of the large New Brunswick incumbents or Weyerhaeuser. And I don't see them wanting to make that expansion right now. And another thing is that when you have Brookfield backing you or you're Brookfield adjacent, you're probably already one of those large players.
Okay, okay, okay. That's interesting. Okay, so thank you a lot for your availability and your insights in this company. I'm done for today. Thank you again, Darcy. This is it for today. This is Hustle Hub. I'm Giacomo. See you next time.
Thanks, Giacomo.